Let's dive into something that impacts your investments, your savings, and frankly, the entire economy: the Consumer Confidence Index. You've probably heard it mentioned on the news, but what is it? And why should you, as an American consumer or investor, care? Simply put, the Consumer Confidence Index, or CCI, is a monthly survey that measures how optimistic or pessimistic people are about the overall health of the economy. It's a snapshot of what consumers think is going to happen, and that thinking has a surprisingly powerful effect on actual economic activity. Now, who actually does this surveying? It's the Conference Board, a private non-profit research organization. They survey around 5,000 U.S. households every month. They ask questions about current business conditions, people's personal finances, and their expectations for the future, things like job security, income, and the business outlook. The results are then crunched into a single number. A number above 100 generally suggests consumers are optimistic, meaning they're more likely to spend money. A number below 100 indicates pessimism, and people tend to tighten their belts and save more. The base of 100 is set to 1985, meaning that level of confidence is the benchmark. So why is this relevant to you? Well, consumer spending makes up around 70% of the U.S. economy. That's a huge chunk. If people feel good about the future, they're more likely to make big purchases: cars, homes, appliances, and even smaller things like dining out and entertainment. This increased spending drives economic growth. Conversely, if people are worried about losing their jobs or a potential recession, they'll cut back on spending, which can slow down the economy. Let's look at a couple of simplified examples. Imagine the CCI jumps significantly after a few months of steady gains in the stock market and falling unemployment. This signals strong consumer confidence. Businesses see this positive trend and become more optimistic about their future sales. They might then increase production, hire more workers, and invest in expansion. This creates a positive feedback loop: more jobs, more income, more spending, and even more confidence. Now let's flip the script. Imagine the CCI suddenly plummets after a geopolitical event or a worrying inflation report. Consumers get spooked. They postpone that new car purchase, cancel vacations, and start saving more. Businesses respond by cutting back on investment and potentially laying off workers. This creates a negative feedback loop, potentially leading to a recession. How does this affect the markets? The stock market is often seen as a leading indicator of economic health, and the CCI is often correlated with stock performance. A rising CCI often coincides with a rising stock market, as investors anticipate increased corporate earnings due to higher consumer spending. However, it's not a perfect relationship. The stock market can be influenced by many factors, including interest rates, global events, and company-specific news. Bond markets also react to changes in the CCI. A stronger-than-expected CCI reading can lead to higher interest rates, as investors anticipate increased demand for credit and potential inflation. This can lower bond prices. Conversely, a weaker CCI reading can lead to lower interest rates and higher bond prices. Real estate is also heavily influenced. Higher consumer confidence often leads to increased demand for housing, driving up prices. Lower confidence can cool the housing market. It's also important to remember that the CCI isn't just about current conditions. It's heavily weighted towards expectations. What consumers think will happen in the future has a huge impact on their behavior today. This is why the CCI is often closely watched by economists and policymakers. The Federal Reserve, for example, uses the CCI as one data point when making decisions about monetary policy. If the CCI is consistently strong, the Fed might be more likely to raise interest rates to prevent inflation. If the CCI is weak, the Fed might lower interest rates to stimulate economic growth. Now, while the CCI is a useful indicator, it's not foolproof. It's just one piece of the puzzle. Other economic indicators, such as GDP, unemployment rate, and inflation, also need to be considered. It's also important to look at the trend of the CCI, rather than just a single monthly reading. A consistent upward or downward trend is more significant than a one-time fluctuation. In summary, the Consumer Confidence Index is a monthly survey that measures how optimistic or pessimistic consumers are about the economy. It's a key indicator of consumer spending, which drives about 70% of the U.S. economy. Changes in the CCI can affect the stock market, bond market, and real estate market, and it's closely watched by the Federal Reserve when making monetary policy decisions. While it's not a perfect predictor of economic outcomes, it's a valuable tool for understanding the overall health of the economy and making informed investment decisions. Remember, this information is for educational purposes only and should not be taken as financial advice. Always consult with a qualified financial professional before making investment decisions.